Following on from the 9 general principles in the Code of Conduct, we'll now look at the concept of professional investors. Now, if professional investors comes up in the exam, it would be one question, or topic may be referred to in questions in other topics. Now, the big deal of professional investors, first bullet point, they do not need the same degree of protection that the ordinary retail investor might require. And so we are going to relax some of the requirements, and we'll see what requirements we relax in a moment. But there are 3 categories of professional investor recognized. Institutional professional investors, they are defined in the Securities and Futures Ordinance and tend to deal for themselves as principals. Corporate professional investors, prescribed in the professional investor rules, and their corporates, trusts, partnerships. Family office is a classic corporate professional investor. And individual professional investors, high net worth individuals who are trading, investing on behalf of themselves. Now, the material goes on to look at the definitions in more detail. So we've listed the classic institutional professional investors, and these are the big players: generic exchange companies, intermediaries, that's registered institutions and licensed corporations, and similar overseas providers. So it's worldwide. AFIs, all the banks, and similar overseas institutions, the insurance companies, collective investment schemes that are authorized in Hong Kong and their overseas counterparts. Registered schemes such as the Mandated Provident Fund Ordinance and also Occupational Retirement Scheme Ordinance, retirement schemes, and their service providers, trustees, investment managers, administrators, etc. And then they finish off with government, central banks, and multilateral agencies. We then have the corporate professional investors. A little bit more detail in the definitions. Trustee companies responsible for total assets of not less than 40 million. So we now have a monetary criteria. Corporations or partnerships having either a portfolio of not less than 8 million or total assets not less than 40. And corporations that act solely as investment holding companies and are wholly owned by persons who belong to any of the above 2, and then holding companies of the above 2 categories. But as I say, family offices are a classic corporate professional investor. And then the individuals, high net worth individuals having a portfolio of not less than 8 million Hong Kong. That's just over 1 million US, which is not a lot these days. And it includes spouses, children, where portfolios are held jointly, and portfolio held by a corporation wholly owned by the individual. Now that spouse, children point, be aware of it, because I've seen a question where they said, what of whose investments should we include when deciding if someone is an individual professional investor with regard to the 8 million criteria? And they listed siblings, parents, spouses, and children. And it's only spouses and children that are included. Okay, so what are the conditions that we relax? What are the waivers that are applicable to the professional investors? The Securities and Futures Ordinance provisions that do not apply to professional investors, the unsolicited call provision. Now, we'll deal with unsolicited calls and the fact that they're illegal in topic 9. And requirements for offers by intermediaries, I wouldn't worry about that, but just be aware, you can cold call professional investors, try and sell them. They are exempt. Non-applicable code of conduct requirements. Now we have a number of them. Information for clients, the details there. And then underneath those points, just before B, I've put exemptions A, 1, 2, and 4 apply to individual professional investors. Just those. And above that, we're told all above exemptions apply to institutional and corporate PIs. So it gets a little bit intricate. And as a result, I haven't seen that in these intricacies examined. And then B, information about clients that you don't require to collect. And then client agreement, the need to enter into the client agreement. And I've listed at the bottom there who these exemptions apply to. For example, B at the bottom, all above exemptions apply to institutional PIs and corporate PIs. And then the client agreement exemption applies to institutional and corporate PIs, not individual PIs. Then we look at the concept of discretionary accounts. The need to obtain client's approval. We're still in the waivers for professional investors. They need to explain the written authority. They need to disclose benefits. And we're told all above those exemptions apply to institutional PIs and corporates, not individuals. So they made it just a little bit more detailed than a few years ago. And do you have to be aware? To be honest, I'd be aware of the big picture. I wouldn't concern myself too much with knowing all the detail, but be aware all the exemptions apply to institutional PIs and mainly corporate PIs, but not individual PIs. Now we've got a little bit more detail. Institutional PIs, I beg your pardon, licensed and registered persons are automatically exempt from the above listed requirements, and that's what I've put in the sort of annotations. Corporate PIs and individual PIs, to be able to apply the exemptions, the licensed or registered person must write to the client explaining the consequences of being treated as a PI and the information that will not be received, and the fact that they have the right to withdraw from being treated as a PI, professional investor. With corporate PIs and individual PIs, you should obtain written and signed declaration from the person if they are going to be treated as such, and carry out confirmation exercise annually. Corporate PIs only. If licensed registered is satisfied the corporate PI is an appropriate corporate structure, appropriate investment processes and controls, as investment decision makers with sufficient background and experience, and is aware of the risks involved in making investments, then the corporate PI is exempt from all code of conduct requirements listed above. As I've said, if you're going to get a question on PIs, it will be one question only. Be aware of the material, do the practice questions, but I wouldn't dig any deeper. Continuing with the code of conduct, paragraph 2.3 on sponsors. Remember, sponsors are the institutions that will help companies list on the stock exchange, and there are some particular code of conduct requirements that we have listed there, and I would suggest they're all fairly straightforward. Electronic trading, yes, there are code of conduct requirements, but we cover them in topic 6. And regulated activity with additional conduct requirements, there are activity types 1, 2, 3, and 8, and those additional conduct requirements are covered in other papers, for example, paper 2, paper 3, paper 6. We leave the code of conduct and move on to the fund manager code of conduct. Now, as I said earlier, you get a higher hit rate, a better return on time invested, because you could have 1 or 2 questions on the fund manager code of conduct, and there's nowhere near as much material as there is on the code of conduct. Now, this has been developed recently to make a distinction between 2 types of fund management, and that's why I'm going to just highlight the top notes on page 5.17 under para 3. Fund manager code of conduct applies to fund managers being persons licensed or registered with SFC whose business involves the management of collective investment schemes, whether or not they're SFC authorized, and discretionary accounts, whether in the form of an investment mandate or a predefined model portfolio. So we've got collective investment schemes and discretionary accounts. So discretionary account is where you're managing a portfolio, you're managing the funds of an individual, and that individual has given you the discretion to decide what to invest in, as opposed to collective investment scheme management. And so they do make the distinction and sometimes refer to it. If fund manager code of conduct is inconsistent with any other legislation, rules, codes, or guidelines, stricter provisions apply. Remember that. That applies to all codes. If there's any overlap or any confusion, it is the stricter provisions that apply, and that has been examined. Provisions are similar to the general code of conduct. This is the fund manager code of conduct. Those unique to the fund manager code of conduct are then detailed below. So please read through the requirements with regard to honesty and fairness, information for clients, conflict of interest, the requirements of cross trades at the top of page 5.18. You should be aware of that. Compliance, how fund managers must comply, who relevant persons are. Now, I've skimmed through that because it's material that you can read and that is specific to the world of fund management. Also, we have a specific code for corporate finance advisors. And here we cover the areas of conflict of interest, the standard of work expected, the duties to clients, communication with regulators, and again, personal account dealings. None of this is difficult. It's not really specific to Hong Kong. It's not Hong Kong legislation. It's very international in scope. Read through that and be aware of it. Code of conduct for persons providing credit rating services. This is a strange one because I have seen an exam where they had 2 questions on it and then many exams where they've not covered it at all. Now, the code of conduct was deemed necessary after the problems of 2008 and the credit rating agencies giving mortgage-backed products, securities, mortgage-backed securities, AAA ratings when the underlying assets, that is the mortgages and the properties in the US, were losing value, and yet the credit rating agencies were still giving stellar ratings. And so because of that, the whole practice has been tightened up. And it's been tightened up in terms of ratings methodology. The methodology should be seen to be robust, and the points are listed there. The credit rating agencies should be seen as independent and should avoid conflicts of interest. And that was one of the problems in 2008, where the credit rating agencies were being paid by the institutions who were issuing these mortgage-backed securities. And then responsibilities to the investing public. And I'm going to highlight one point in this because I've seen it examined a number of times. And that is the second bullet point. A rating must be communicated to the rated entity before it is issued or revised to give the rated entity the opportunity to clarify any possible factual misperceptions. Now, that's not something that you would naturally assume. So when a credit rating agency gives a rating for a bond issue of a corporate, for example, they must communicate to the corporate what the rating is going to be before they issue it to give the corporation the opportunity to clarify any factual misrepresentation. So I just highlight that one. And I'm going to highlight something else with regard to the code on open-ended fund companies. This has not been around long. And remember, open-ended fund companies are structures for the management of funds. And just to remind us, top bullet point, we're told that the open-ended fund companies allow investment funds in Hong Kong to be established as incorporated companies with limited liability and variable capital as an alternative to the unit trust structure. Now, the point I want to highlight is halfway down, and it says there are additional code requirements for private open-ended fund companies, and they cover investment scope. And it's this investment scope that they have examined. Private OFCs are designed to operate as investment vehicles and so should not operate as corporate entities for general commercial business or trade. And at least, and listen in, at least 90% of an open-ended fund company's gross asset value must be invested in normal asset management classes of investment. And they've highlighted those as listed equities, debt, foreign exchange, and cash, not private equity investments. And that was a point that they highlighted in the exam. And then there's more material on changes to the scheme, fund operations, and disclosure. So just one page, be aware of it. If it's examined, it would be one question. And then finally, code of conduct for share registrars. It exists, and to my mind, it has never been examined in 17, 18 years. So take that into account. Be aware such a code exists. So that's the end of topic 5. Now, topic 5 is not considered detailed, troublesome material because a lot of candidates are aware of the general concept from internal operational manuals, internal operational training, etc. But there will be a number of questions. And once again, best way to prepare, best way to deal with your short-term memory with all this material is to go to the practice questions that we have posted on Examinator.online.